In this simulation, the United States dollar loses half its purchasing power in 3 weeks. And what you're about to witness is how that collapse moves through every layer of society. From Wall Street trading floors to grocery store checkout lines based on historical patterns from currency crises in Argentina, Zimbabwe, and Weimar Germany. This isn't speculation. This is a minute-by-minute reconstruction of what happens when the world's reserve currency breaks, and the speed at which it happens will challenge everything you think you know about economic stability. But there's a specific moment buried deep in the second week where something shifts that economists rarely discuss in public, a threshold where the collapse becomes irreversible even if governments intervene. This simulation uses real data models, historical parallels, and monetary theory to show you not what might happen, but what has happened every single time a major currency enters freefall. The sounds you'll hear, the silences between the chaos, they mark the exact points where your life would change forever. We assume the trigger is sudden, a confluence of debt ceiling crisis, loss of confidence in treasury bonds, and a coordinated move by BRICS nations to settle oil trades in alternative currencies. But the specific cause matters less than the mechanics of what follows. In the first 18 hours, it's still abstract, numbers on screens in lower Manhattan. Traders watching the dollar index plunge from 93 to 78 before the opening bell, algorithms firing sell orders faster than human comprehension. The Federal Reserve convenes an emergency meeting at 4 a.m, officials arriving through underground tunnels to avoid cameras, and their faces carry a specific kind of exhaustion. The kind that comes from knowing the tools they have won't be enough. They announce a rate hike, 300 basis points, a move so aggressive it would normally trigger recession fears, but in this scenario, it barely slows the descent. The dollar continues falling. By day 2, the abstraction begins to solidify. Import-dependent businesses, the ones that source inventory from China, Mexico, Vietnam, they're suddenly paying double for goods that haven't even shipped yet. And the phone calls start quiet, panicked conversations with suppliers who want payment up front in euros or yuan. A clothing retailer in Minneapolis gets an email that their next container shipment, already on a vessel crossing the Pacific, will cost 83% more than the invoice they signed 4 weeks ago. They have 72 hours to wire the difference or the container gets rerouted. The retailer doesn't have the cash. They call their bank for a bridge loan, but the bank is already drowning in similar requests. And the loan officer's voice has a new quality to it, a tightness that wasn't there last month. The retailer begins calculating which employees to let go first. Gasoline prices move faster than almost anything else. Crude oil is priced in dollars globally, so when the dollar weakens, oil-producing nations need more dollars per barrel to maintain their revenue in their own currencies. And that cost passes directly to refineries, distributors, and then to the pump. By day 3, the national average jumps from $3.40 to $5.10 per gallon, and it's still climbing. A logistics company in Ohio runs the numbers and realizes their fuel costs have increased by 47% in 72 hours, erasing their entire quarterly profit margin. They add a surcharge to every delivery, which means every business that relies on shipping, which is nearly all of them, now faces higher costs they'll have to pass along. A grocery chain in North Carolina receives notice that their distribution expenses are up 38%. They hold an emergency pricing meeting at 6 a.m. But this wasn't the real problem. The real problem was what happened inside people's minds as they stood in front of those grocery store shelves on day 4. A gallon of milk that cost $4 last week now shows $5.70 on the digital price tag. And the shopper pauses, not just from sticker shock, but from a deeper calculation. The realization that their paycheck, deposited 2 days ago, is already worth less than when they earned it. They look at the eggs, the bread, the chicken, and they start doing math they've never had to do before, projecting forward, wondering if prices will be even higher next week. Some of them buy extra, filling carts with non-perishables, and the checkout lines grow longer. The store manager notices the pace, the urgency in people's movements, and sends a message to corporate asking about inventory levels. Corporate doesn't have a good answer yet. Currency collapse follows patterns that feel almost biological, spreading through systems and waves, and we're watching the first wave crest. Importers and fuel-dependent industries got hit within days, but now the impact reaches salary workers. Anyone paid in dollars who buys goods priced in global markets or influenced by import costs. A teacher in Arizona notices her grocery bill has increased by $62 over 2 weeks for the same items. She's on a fixed salary, negotiated last year, and there's no mechanism for immediate adjustment. Her purchasing power has dropped by a quarter in less than a month, and she's not alone. 40 million American workers are experiencing the same silent pay cut simultaneously. The phrases start appearing on social media. Quiet at first, people sharing screenshots of receipts, comparing prices, asking if others are seeing the same thing. On day 7, the Federal Reserve makes another move, but it's defensive now, reactive. They announce unlimited dollar liquidity swaps with allied central banks, trying to stabilize foreign exchange markets. and they begin selling treasury bonds from their balance sheet to absorb excess dollars from circulation. The problem is, the global demand for dollars is falling precisely because confidence is falling, and no technical intervention can restore confidence once it's truly broken. A trader in Singapore watches the announcement and shorts the dollar further. The currency drops another 6% in the next 16 hours. Something else was starting beneath the surface. Retirement accounts, pensions, 401ks, they hold trillions in dollar-denominated assets. And as the dollar's value crumbles, so does the real value of those savings. A 68-year-old woman in Florida checks her retirement portfolio and sees the balance is technically the same in numerical terms, but she reads an article explaining that her purchasing power has fallen by 34% in 10 days. She calls her financial advisor, who tells her that shifting to foreign assets now means crystallizing losses and paying conversion fees at the worst possible moment. She asks what she should do. The advisor pauses too long before answering. She doesn't sleep well that night. By day 9, we're watching a psychological threshold being crossed. People begin to view dollars not as stable stores of value, but as depreciating assets they need to convert into something tangible as quickly as possible. A construction worker in Texas gets his paycheck. Instead of depositing it, he immediately drives to a sporting goods store and buys ammunition, tools, anything he thinks will hold value better than cash. The store sells out of certain items by mid-afternoon. A family in Wisconsin withdraws $8,000 from their savings account and buys gold coins from a local dealer who has tripled his prices in a week but still has customers lining up. The velocity of money, the speed at which dollars change hands, begins to accelerate, and this is dangerous because in hyperinflationary spirals, velocity becomes a multiplier that makes everything worse. Businesses start refusing to honor prices. A car dealership in Nevada tells customers that the sticker price is only valid for same-day purchases, and if you come back tomorrow, they'll requote based on current conditions. A contractor in Michigan sends a revised estimate to a client, noting that material costs are now variable, and the quote is only guaranteed for 48 hours. These are rational responses to irrational conditions, but they contribute to the sense that the ground is disappearing beneath everyone's feet. A wedding venue in Tennessee receives a panicked call from a bride, asking if the price they agreed on 6 months ago is still valid for her ceremony in 3 weeks. The venue owner wants to be kind, but their own costs have exploded, and they explain with genuine regret that they'll need to renegotiate. The numbers looked stable for about 16 hours on day 11, a brief plateau that gave false hope until they didn't. International reactions compound the crisis. China's central bank announces they're reducing dollar reserves in favor of a broader basket of currencies. Japan follows cautiously. The European Central Bank issues a carefully worded statement about monitoring currency markets, which everyone understands as distancing themselves from the dollar's fate. Sovereign wealth funds in the Middle East quietly shift allocations. These aren't coordinated attacks. They're rational actors protecting their interests. But the cumulative effect is a feedback loop. The more they move away from dollars, the weaker the dollar becomes, which justifies further movement away. A pension fund manager in Norway watches the cascade and makes a decision that will affect 100,000 retirees he'll never meet. By day 13, we're deep into the second-order effects, the consequences that don't make headlines but reshape daily existence. Restaurants can't price their menus anymore, so some start using daily boards with chalk prices that change between lunch and dinner service. A diner in Oregon prints new menus 3 times in 1 week before giving up and just writing prices on a whiteboard. Customers notice, some stop coming. The owner calculates that her revenue is up in nominal dollars but down in real purchasing power, and she's working longer hours to earn less. She considers closing on Mondays to save costs. Supply chains begin experiencing friction at every link. A furniture manufacturer in North Carolina imported hardwood from Brazil, steel brackets from Vietnam, and upholstery fabric from Turkey, all priced in contracts signed when the dollar was strong. Those contracts are expiring or being renegotiated, and every single input cost has surged. The manufacturer tries to raise prices, but retailers push back, and orders get canceled. The factory floor, which ran 2 shifts last month, drops to 1 shift this week. 14 workers get temporary layoff notices. They go home and look at their own bills, now higher, and start making calls about other jobs. But everyone's hiring freezes are beginning. What happened next wasn't immediate, but it was inevitable. Credit markets start seizing up. Banks become reluctant to issue new loans when they can't predict what a dollar will be worth in 30 days, let alone 30 years. Mortgage applications drop by 61% in a single week. A young couple in Colorado, pre-approved for a home loan 2 months ago, gets a call from their lender explaining that rates have changed and their approval is no longer valid. They'd already given notice to their landlord. They start searching for rentals in a market where landlords are raising prices weekly. Someone else moves into the apartment they were leaving, paying 40% more than they did. On day 15, the psychological weight becomes visible in ways that are hard to quantify but impossible to ignore. A bank teller in Michigan notices that customers withdrawing cash are asking for smaller bills, 5s and 10s instead of 20s and 50s, because they want flexibility, the ability to spend exact amounts without getting change. They worry will be worth less tomorrow. A grocery store cashier in Georgia observes people spending longer at the checkout, recalculating, putting items back, their faces carrying a specific tension. A teacher in Pennsylvania tells a colleague that 3 students in her class asked if lunch prices were going up again. The question came from kids who normally never think about money. The government announces relief measures, payroll tax holidays, subsidized fuel programs, direct payments. But these take time to implement, and they inject more dollars into an economy where dollars are the problem. The economist at a policy institute writes an internal memo suggesting that fiscal stimulus during currency collapse is like treating dehydration with salt water, but the memo stays internal. Publicly, officials express measured confidence. Press conferences feature phrases like temporary volatility and technical adjustments. The stock market, bizarrely, shows green on certain days, but it's illusory. Share prices rising in nominal dollars, while real value evaporates. Energy costs ripple through everything. A hospital in Iowa faces a 49% increase in their electricity and heating bills over 3 weeks. They're nonprofit, running on thin margins, and they begin reviewing which services to scale back. An administrator suggests reducing hours in certain departments. Someone else mentions deferred maintenance, skipping equipment upgrades. These decisions won't kill anyone immediately, but they degrade the system in ways that matter when emergencies arrive. A transit authority in Washington state realizes their fuel budget is exhausted with 11 days left in the month. They start cutting bus routes, prioritizing main corridors, and neighborhoods on the edges lose service. A woman who works night shifts at a warehouse can no longer get home via public transit. She considers quitting. On day 18, there's a moment that doesn't appear in economic models. A small business owner in Tennessee sits in his office after closing, looking at spreadsheets that no longer make sense, and he realizes he's not solving a puzzle, he's watching something fundamental break. He's run this business for 19 years, survived 2 recessions, adapted to market changes, but this is different. The rules have changed mid-game, and there's no strategy for a playing field that's actively dissolving. He thinks about his 7 employees, people he knows by name, whose kids he's met, and he knows what's coming. He stays in the office until midnight, not working, just sitting. International travel becomes a strange mirror. An American tourist in France discovers that her credit card transactions are being converted at rates that make a simple lunch cost $53. She checks her banking app and sees alerts about currency conversion fees she's never noticed before. A business traveler in Japan finds that the hotel room he booked for $200 3 months ago now effectively costs $370 after currency adjustment. He cancels the last 2 nights and flies home early. Americans abroad start cutting trips short. The tourism industry notices. By day 20, there's a quality to public spaces that's hard to name, a subtle change in how people move and interact. Conversations in coffee shops drift toward prices, wages, what things cost, how long savings will last. A barista in Seattle overhears fragments throughout her shift, the same themes repeated by different voices, and she realizes she's become part of a collective anxiety that has no clear resolution. Her own rent is due in 8 days, and her landlord sent an email about adjustments. She picks up an extra shift. The bond market, that vast invisible infrastructure of government debt, shows cracks that matter more than stock prices ever could. Treasury yields spike as investors demand higher returns to compensate for currency risk, which means the government's borrowing costs explode precisely when they need to borrow more. An analyst at a ratings agency runs scenarios late at night, models that show debt service consuming larger and larger portions of federal revenue, and the numbers start looking like the sovereign debt crises he studied in graduate school. Except those were other countries, smaller economies, places where this kind of thing was supposed to happen. And what happens on day 21 isn't a climax, it's a recognition. The dollar has lost 52% of its value in 3 weeks. And everyone from traders to teachers understands that something has shifted permanently. That even if the currency stabilizes tomorrow, the world that existed before is not coming back. A retired couple in Maine sits at their kitchen table with bills spread out, doing arithmetic that keeps producing impossible answers. Their Social Security check is the same number it was last month, but it buys half as much. They're both 74. Starting over isn't an option. They sit in silence for a while. In this simulation, we watched how velocity matters as much as volume, how psychology drives economics as much as policy, how systems built on confidence collapse the moment that confidence breaks, and speed is the multiplier that turns gradual decline into freefall. Historical patterns from other currency crises suggest that the first 3 weeks are the shock phase, where old assumptions die and new realities haven't yet formed. And it's in that gap, that space between what was and what will be, where the most profound human costs accumulate, quiet, personal, uncounted in the official statistics. The room felt still, somewhere in a financial district. as screens glowed with numbers that would matter tomorrow and the day after and the month after. Numbers that represented choices not yet made, losses not yet realized, futures not yet rewritten. Someone whispered a question that had no answer, or maybe too many answers, and the soft hum of servers vibrated behind walls that separated calculation from consequence. If a moment like this ever reached the place where you wake up each morning, where you earn and spend and plan and hope, what would it mean for the version of life you're building right now?